guest of honor, our resource person, Dr. Ashutosh Goswami, from Department of Commerce, Satyavati College, for the inaugural lecture in this webinar series today. I would also like to welcome and thank our college principal, Professor Nirmajinder, for joining. I think she's not there, and for her a constant support and encouragement in making this endeavor successful. Considering the aftermath of worldwide pandemic and living in these trying times of uncertainty and the ever-changing global world, smart investment plans have becoming an absolute necessity. Our speaker today will rightly help us conquer investment fears and enhance our decision making. So when I invite Dr. Anupam Sani sir to kindly grace us with few words. Over to you, Dr. Sir.
Thank you so much, Lex. Good afternoon, everyone. And it really has been an honor to organize and be part of such a wonderful event. And so on the behalf of webinar committee, I would like to thank and share my heartfelt gratitude to our principal, because without her support, these kind of lecture series would have not been possible. Today, we have among us Dr. Ashutosh Goswami for our inaugural lecture. Talking about Dr. Ashutosh, I must tell you, he is teaching in our college only. He is an assistant professor in Department of Commerce. And he has been teaching more than 13 years. Prior to joining Satyavati College, he also has teached in Delhi School of Economics, Department of Commerce, as well as Sri Guru Tegh Bahadur Institute of Management and Information Technology in Press University as a faculty member. His area of interest basically includes behavioral finance, financial management, and investment analysis. So, and more than that, he has credited 2 books and more than half dozen of research papers under his name. He also has UGC GRF fellowship. He was awarded UGC GRF fellowship from University Grant Commission. And he is a life member of Indian Commerce Association, Indian Accounting Association as well. There's so many things I could tell you about him, but I think it's better that we could listen to him. So over to you, Dr. Ashutosh.
Am I audible?
Yes, you're audible.
Thank you so much, Dr. Anupam, Dr. Lakshay. So, respected Principal Professor Nirmal Jindal, convener of webinar committee, Dr. Anupam Sani, co-conveners, Dr. Shweta Kalra, Dr. Lakshay Batra, Mr. Kundan Kumar Raj, Ms. Swati Sharma, Mr. Ravinder Ram, and Ms. Shranya Ganguly. So, we all are gathered here this afternoon to learn how to create our wealth or how to build our wealth. So this is the topic which I have chosen today, is of interest of all of us. We all want to have more and more wealth in our lives. We all have unlimited wants. We all have unlimited desires. And to fulfill our wants and to fulfill our desires, we need to have wealth. So wealth plays very important role in our lives. So that is why I have chosen this topic. Since I am from a finance background, I did my master's, both MCom and MBA in finance. I did my PhD also in finance. I worked with Security Exchange Board of India for a few years as a resource person. And my role was to educate the general public about the financial planning. So when I was making my presentation, so I was getting confused because there are so many areas which are connected with finance. So I was confused from where to start, right? So we can learn how to make our portfolios. We can learn what all options are there in the stock market to invest. We can learn what is future, what is option. So there are n number of things which are related with the stock market. So I was a bit confused. Then I thought that I should include all those content, or I should include only those content which would be more useful for those people who doesn't know anything about the stock market. So my today's webinar is going to help those people who doesn't going to help them more, who doesn't know anything about stock market, because they don't need to unlearn anything, right? So shall I start, Dr. Anupam? Should I share the screen now?
Yes.
Okay, I'm sharing the screen. Just a second, give me a second. So here you can see, 1 minute. Yeah. So here you can see uh, there is one quote which says that if you don't find a way to make money while you sleep, you will work until you die. And you can see one picture on the first slide. And who is this person? I don't know how many of you know him. So he is Warren Buffett, and Warren Buffett is the most successful investor on this earth. His net worth is 11,000 crore US dollar. Sometimes he finance US government also. So he has created 11,000 crores US dollar by investing in stock market. So this is his net wealth. So we all want to, reach to that level. So through my webinar, I'll give you few tips. By following those tips, you can also earn that much amount of wealth one day in life. So he says that if you don't find a way to make money while you sleep, you will work until you die. What does it mean? So let's try to understand what he is trying to convey through this quote. He says that to have profits in the stock market in the long run, I repeat, to have profits in the stock market in the long run, you don't need to know anything. No knowledge, no skills are required to have profits in the stock market in the long run. And when he says that, it is there is something hidden which we need to understand. So I start my uh, topic with the meaning of wealth building. So some of you may be getting confused that what is wealth. So let's try to understand what is wealth first. Yeah. So what is wealth, or what is wealth creation? When we say wealth means assets, and those assets which we are having or which we are acquiring. We asset may be in the form of land. Assets may be in the form of land, it may be in the form of cash, it may be in the form of stock, it may be in the form of commodity, or it may be in any other form. So wealth creation is a process of acquiring asset. When I say acquiring asset, right type of asset, acquiring right type of asset, because these assets are going to help us in generating income over a long period of time. So we are going to learn that what all sort of asset we should acquire to generate more and more income in the long run. So we can to start the wealth creation process, we need to understand what is the difference between active income and passive income. So here, regular income, we all are getting regular income. We all are in colleges, or we may belong to different professions. So we are earning regular income from our profession. We get regular salary from our colleges. So regular income basically helps us to meet our day-to-day expenses. So this is one thing. We need regular income to meet our, this is the primary purpose of getting a regular income. And now let us understand the secondary purpose of regular income. The secondary purpose of regular income is to create the wealth. Regular income plays an important role in the wealth creation. If we want to create the wealth, we need to have regular income. So we need to work hard, and we need to really enter into some profession if we are not working to have regular income, because to create wealth we need regular income. Second point, regular income contributes toward wealth creation. So we create wealth from our regular income. It is not possible to create wealth unless and until we have regular income. Now, here the question arises. We earn, but how can we create wealth? Right? Whatever we earn, we spend on our day-to-day activities. So we sometimes we feel that we are not left with anything for the investment. So we need to follow a formula. We should not spend 50%, more than 50% of our regular income. We should try not to spend more than 50% of our income, because savings are possible only because we sacrifice our expenditure. So we need to sacrifice our expenditure to have savings, and saving leads to investment. We need to understand this relationship also. Saving leads to investment, and investment leads to capital formation. So this is a vicious circle. So saving is the first step. So we need to save a lot. So from today onwards, after attending my webinar, you all should try to save as much as possible, because you can create your wealth in the long run only and only when you are having savings, adequate saving. So this is wealth. So when we have, if I say that I have lot of saving, now the question arises, why do I need to save, or why do I need to create wealth, or why it is so important to create wealth? So the answer is to maintain as well as improve our standard of living. So we all want to improve our standard of living year by year, day by day. We all want to live in a big houses. We all want to buy a big cars. We all want to acquire good assets to live a successful life. So to improve the standard of living and to maintain the standard of living, we need to create wealth, and saving is the basis of wealth creation. Now the second reason why we need wealth, the second reason is to achieve our long term goals. We all have long term goals. Some of us save for the education of our children. Some of us save for the marriage of our children. Some of us may save for the world tour. We may have a dream to go around in the world. So we may have that goal also. So we may save for retirement. So there are n number of purpose, there are n number of goals. So we all are living in different phases of our life. We are going through different phases of our life. So our goals depends on our phase of life, in which phase of life we are right now. So our regular income is not enough to fulfill our long-term goals, because we spend 50% on our day-to-day expenses, and we save only 50% of it if we follow, if you people follow my formula. So therefore we all need to learn the process of wealth creation, so that we can improve our standard of living as well as we can achieve our long-term goals. Now, the third reason why we need to create wealth is wealth creation is an essential component of financial security. We all want to have financial freedom. We all want to achieve financial freedom. If you want to achieve financial freedom, then you need to create your wealth. So wealth creation is very, very important for financial security. It is important for improving the standard of living. It is important for achieving the long-term goal. So I think now you all have understood why I have taken this topic for discussion today. Now I am coming to the third slide. So here I have mentioned few things which I am going to cover in the next few slides. So I have divided my presentation into 4 parts. First is ABC of investing. Since in the very beginning, I cleared this point that my webinar is going to be helpful for is going to be more helpful for those who doesn't know anything. So they need to understand the ABC of investing. When I say ABC of investing, basically some basic term. It is not possible, my dear participants, to tell you what all things we study in finance. There are n number of people who have written n number of things on financial market. It is a very big thing. Not possible for any speaker to make you understand everything about investing in 1 hour or one and a half hour. People study it for years. to learn it. But I promise you to make you understand what is the ABC of investing. So the ABC of investing, uh, ABC, here I have taken very few things because of limitation of time. It was not possible to include all the ways where we can invest. So I have taken only two areas where you can invest. You can invest either in debt. I give you an example of debt. I know when I talk with my colleagues in the college, so most of them say that to save the tax, we invest in PPF, right? Public Provident Fund. Some people say, those who are having a girl child, they say that they invest in Sukanya scheme, right? Other people say that they invest in NPS. So PPF, NPS, your Sukanya scheme, your post office scheme, all those schemes come under the debt. They are debt. We call them debt. Now onwards, you all should know this, that you are investing in debt funds. Why we call them debt funds? Because we get fixed rate of return. Government gives fixed rate of return on PPF. Government gives fixed rate of return on Sukanya scheme. Government gives fixed rate of return on other post office and scheme. We also get fixed rate of return on FDs. So FD, PPF, NPS, and Sukanya scheme all are debt funds. And the second component of investment is equity. So equity, what is equity? Equity, when we invest in the company, right? So what is the difference between debt and equity? In case of debt, we get fixed rate of return. But in case of equity, when we invest in equity, our return varies. So there are many times people ask this question, sir, what is risk? How do you define the term risk? So I always say to them, variation in return is risk. When your return varies, it is a situation of risk. So risk arises because of variation in return. So we all belong to a we all do not want to take a risk. So that is why there are very few people. I tell you one thing. When I was doing my PhD was on behavioral finance, which Dr. Anupam Sani mentioned in the introduction. So when I was doing my PhD, I did both primary analysis as well as secondary analysis. So when I was doing the primary analysis, I have prepared a questionnaire and circulated among the people. And I was surprised to know that there are very few teachers in our college, in our universities, who invest in the stock market. So it was an eye-opening experience for me to know this, that educated people do not invest in the stock market. Then I realized why they do not invest. I asked few people, they said, okay, because stock markets are risky investment. I said, okay. Then I studied the stock market and I found that stock markets are doing well. And people say that it is a risky venture, but why it is happening? Then in my PhD, I tried to find out what all factors which affect the investors while taking their investment decision. And I found that people suffer loss in the stock market because they are having behavioral biases. They suffer from behavioral biases. That is why they suffer loss. And that is why people don't prefer to invest in the stock market. I read one survey of SEBI, Security Exchange Board of India. They did one survey in year 2015 at all India level. And what they found, you would be surprised to know this, that hardly 2% of the population of our country invest in the stock market. I repeat, hardly 2% of the population of our country invest in the stock market. And if we compare it with US, we all want to become US, right? So if we compare it with the US, in US, more than 50% people invest in the stock market. So we really need to change our way of thinking. We really need to understand, okay, how we can make profit in the stock market. So to because what happened in stock market, when we invest in the stock market, the corporate, what we are doing, we are giving our savings to the corporates, and corporates invest it in their businesses. When their businesses will grow, so they will get benefit of it. Country will also get benefit of it. I tell you one very interesting point here, that it is the business, mark my words, it is the business which is the power center of the economy. Business is the power center of the economy. If I say business is the power center of the economy, I mean it is the business which gives revenue to the government in the form of taxes. It is the business which gives us goods and services. We are using different gadgets, we are using different cars, and we are having different things which we use in our daily life, and these things are being given to us by the business houses, and business houses raise their funds in the stock market, and we do not invest in the stock market. So, and the third thing, it is the business which creates the employment. Our children, our students get jobs because of business. So business is the power center of the economy, and we are not giving our funds, we are not investing our savings in the businesses. Now, to achieve, now this is all about the debt and equity. So I'm going to talk about these two components. I'm going to focus on equity because my purpose is to teach you how to create wealth, not how to save, right? Because you all know how to save in debt, right? We save in debt, but the purpose of my webinar is to teach you how to invest in the stock market and how to have more and more profits in the stock market. So third point is to achieve important goals, right? You can do one exercise, all of you, after my webinar or during my webinar, you can do this exercise. You write down all your goals, important goals which you want to achieve in the next 5 years, right? And if you have some goals which you want to achieve in the next 5 years, I can see there are few people who were associated with this webinar series committee. They are unmarried. They may be planning for the marriage in the next 5 years. So we can take it as a short term goal. So they need fund to have a successful marriage, right? So write down your short term goals for which you need the fund in the short run. And for short term, to achieve short term goals, always invest in debt. Always invest in debt if you have a short term goal of 5 year or less than that. But if you have a long term goal, if you have a goal which you want to achieve after 15 years or 20 years, then always invest in equity market. I tell you what we all do, what we Indians do. We invest in debt for a long term, right? We invest in PPF because it is for 15 years, right? If you need a fund after 15 years, my dear friends, my dear participants, so it is better to invest in the stock market, because in the long run, so we always earn huge amount of profits in the stock market. For long term, we invest in the debt fund. So this is the big mistake which is being made by all of us. So if you have a short term goal, invest in debt fund, and if you have a long term goal, invest in equity market. Now you all must be thinking of this, he's saying that invest in stock market, but we have always heard this and we have experienced this, that whosoever invest in the stock market, they suffer loss, right? So how many of you can write it down in the chat box, how many of you think that by investing in the stock market, people lose their money? Please write it down in the chat box. I want to know this. How many of you think that people suffer loss because of investing in the stock market? Because I am going to tell through this webinar how you can make a lot and lot of profit by investing in the stock market. Please write down if possible. Yes, Dr. Anupam, what do you think? Dr. Anupam, are you there?
Yes, sir.
So what do you think? Do we suffer loss by investing in the stock market? What is your experience? Have you ever invested in the stock market?
No, my father used to do, but I have not invested much in
Why
this
why
thing.
so why
It is
so?
just the
Because
fear. It is
you don't know the skills. You don't have the
exactly,
knowledge, right?
exactly.
So this is the reason most of the people don't invest. But during after my webinar, I am going to give you the skills. During my webinar, I am going to give you the skills to invest in the stock market. Mark my words. So next is, one second. Yeah. So this is the first ABC of investing. What is debt? What is equity? When to invest in debt? When to invest in equity? This is the basics of investing. Now, let us understand the stock market of India, right? We have two major stock exchanges in India. One is debt. sorry, one is National Stock Exchange and another is Bombay Stock Exchange. I know all of you know this. Bombay Stock Exchange and National Stock Exchange are the two major stock exchanges in India. And now here you can see I have written that in India the two major benchmark stock indexes are Sensex and Nifty. So what is Sensex? What is Nifty? We need to understand this thing now. So Sensex and Nifty are the barometers of the stock market. So the question arises, okay, how do we understand Sensex, and what all sort of things are being included in the Sensex, and what all sort of things are being included in the Nifty? So I give the answer of this question. Sensex includes the top 30 companies of the country. Sensex include the top 30. In India we have thousands of companies, and from among those thousands of companies, top 30 companies constitute the Sensex. And in the same way, Nifty constitute the top 50 companies of the country. We have thousands of companies, and we take top 50 companies and we constitute Nifty, and we take top 30 companies to constitute Sensex. Sensex and Nifty. So that is why we say that they are the barometers of the stock market. So if you want to know the stock market, you need to understand the Sensex and Nifty. If Sensex and Nifty are doing well, it means that our stock markets are doing well. If they don't do well, it means that our stock markets are not doing well. And I don't know how many of you read newspaper regularly or watch the news on in the recent past, in the previous 2-3 days. If you have read the newspaper, you must have noticed one thing, that there was a news on the front page that the Sensex and Nifty both dropped by few points, both dropped together. Right. So why it happens? Why they drop together? Why it happens? And when they rise, they both rise together. So what does it mean? Why it happens? They rise together, and why they drop together? It means mathematical people from the mathematics department are there in this webinar, so they can easily understand this. There is one word which we study in mathematics as well as in statistics, and the word is correlation. Correlation means movement. When movement in one variable is accompanied by movement in another variable, they are said to be correlated. So this is correlation. When two things moves together in either positive direction or negative direction, they are said to be correlated. So Sensex and Nifty are positively correlated with each other. So they are the barometers of the stock market. So in the third line, I have mentioned one thing which is very important. Sensex and Nifty also reflect how well an average individual is doing in life. It also reflects the consumption pattern of the country, whether we are doing well or not. If you want to know that we all Indians are doing well or not, if Americans want to know whether Indians are doing well or not, so they can see the Sensex and Nifty. They can see the position of Sensex and Nifty. If an average individual does well in life, it automatically reflects in our Sensex and Nifty. Sensex and Nifty reflects the consumption capacity of the country. And over a period of time, my dear participants, our consumption capacity has increased manifold. I can give you an example of this. 20 years down the line, we never thought of internet. We never thought of mobile phones. We never thought of webinars like this we are doing, right? And now internet, mobile phones, and other gadgets has become an important part of our life. Our consumption has been increased over a period of time. I tell you, our life is better than a life of a king 5 years ago, because at that time they were not having access to medical facilities, they were not having transport facilities. So our life is better than a life of a king 5 years old. So over a period of time, our life is improving. I want to quote one thing here which is very important for all of us to understand. No matter what happens, I repeat, no matter what happens, the next generation will always lead a better life than a previous generation. No matter what happens, the next generation will always lead a better life than the previous generation. And this is a universal truth. If it happens, then what will happen? After 20 years, it is really impossible to visualize what all things we are going to consume after 20 years. But one thing is for sure, that next generation will live a better life than the previous generation. And here, this is the story of Sensex and Nifty. So Sensex and Nifty reflects our consumption pattern, and consumption pattern is increasing year by year. So, and which is being reflected in the stock market. I'll show this in the next few slides. Now, let us understand the word GDP. We all have heard the term GDP several times in our lives, right? We commerce people understand it in a very better way. But I don't know about mathematics and from English or Hindi people whether they understand it or not. I explained it in a simple words. GDP is the final value of goods and services, not only produced but consumed in the country. The final value of goods and services produced and consumed in the country is the GDP of the country. That is how we constitute, that is how we decide how much GDP we are having. So every year, one important fact here, GDP of India is approximately $3 trillion. It is approximately $3 trillion. And you would be surprised to know that. Know this, that market cap or the market value of Nifty 50 companies is $1.5 trillion. You can see that 50% of the goods and so what does it mean? GDP means value of goods and services produced and consumed in the country. And out of total value of goods and services produced and consumed in the country, 50% of the goods, $1.5 trillion, 50% of the goods and services which we consume are being provided by the top 50 companies. Right? Isn't it interesting to know? Yes. So 50% of the goods and services are being supplied by the top 50 companies. So in the long run, the correlation between Sensex, Nifty, and GDP is 1. So what I am trying to explain here is that in the long run, GDP, in the short run, it may happen that the market cap of the companies, sometimes what happens, the market value of the company exceeds the GDP. I repeat, if you people want, please write it down. If the market cap or the market value of Nifty 50 company exceeds the GDP, it means that markets are overvalued. And if the market value of Nifty 50 companies is less than the GDP, it means that the markets are undervalued. So if you want to know whether the stock markets are undervalued or overvalued, you compare it with the GDP. You compare the market values of Nifty 50 companies with the GDP, right? Because we can make profits only when we buy the things, only when we buy undervalued things, and we suffer loss when we buy overvalued things. So it is very important before investing in the stock market to know whether the markets are undervalued or overvalued. Now, the third thing, the third slide of ABC of investing says that the correlation, there is a positive correlation, and the correlation is 1 between Sensex, Nifty, and GDP, which means they all moves together in the long run. If Sensex increases, Nifty increases, GDP increases. If GDP increases, Sensex, Nifty, they all moves together. And GDP has been increasing year by year. It has improved year by year. I tell you, the GDP of US is $20 trillion. Our GDP is $3 trillion. Their GDP is approximately $20 trillion. US is 6 times bigger than us. They are having $20 trillion GDP. So Sensex, up now, let's understand when this Sensex was introduced and when Nifty was introduced. Sensex was started in 1979 with 100 points. Please write down this thing. Those who doesn't understand commerce or finance and stock market, they should write it, because it is going to help you to understand where to invest and when to invest. So Sensex was started in 1979 with 100 points, and Nifty was started in 1995 with 1000 points. And yesterday, when I was going through the newspaper, I found the Nifty touched 16,500 and Sensex touched 55,000. It had come down because of this war, the war which is going on between Russia and the other country. So it has come down, but otherwise, a few years, approximately 1 week or 10 days back, the Nifty touched 17,500 and Sensex was also above 50,000. But it has dropped down because of the war. So we need to understand one very important thing here, that the world events affect the stock markets. Not only the stock market of India, the world effect, the world event, the war between the two countries affect not only the stock market of India, it also affect the stock market of the whole world. Right? Why it happens? We need to understand why the war is going between the two countries and our stock market is getting affected by it. And the simple answer is globalization. And what is globalization? We are living in a globalized world where there is a free flow of goods and services. And when I say globalization, it doesn't mean free flow of goods. Our commerce student, I can see a few commerce student has also joined this webinar. When I ask this question from the student in the class, okay, what is globalization? They simply say, sir, free movement of goods and services. But my dear student, globalization doesn't mean only free movement of goods and services. It means, or it also means free movement of capital. It also means free movement of technology. So if I say free movement of capital, so if something happened in the European country, so our stock market, that is why our stock market gets affected by it. Now I want to show the Excel sheet. One second. Now I have written few things. Now you can see I have taken 1980. Sensex was started in 79, but I have taken it 1980 just to make this things simple. And in 2000, it is 55,000 to 2022. So you can see here that it was started in with 100, and now today it reached to 55,000. And then I calculated the rate. So here you can see the formula. I am one second. So here you can see the formula. So rate is equal to 42. 1980 to 22, approximately 42 years. We started with zero. We minus 100. We invested only once. The person who invested in 1980, 100 rupees. So what happens? So here you can see that 100 rupees has increased to 55,000. So you can see the return is of 16% in the stock market. And how much return we are getting in the banks these days? Can someone tell me, Dr. Anupam, how much return we are getting on FDs these days? Anyone can answer this question. Tell me.
8%, sir?
Not 8%. Nowadays, it is less than 8%. Yeah,
5 to 6%, sir. It's
5 to
5 to
6%. Yeah, absolutely right. 5 to 6%. But stock markets are giving us 16% return. Right. I'll come back to this slide again. I just want to tell you that stock markets are doing well, but people are not. People are not investing. Everyone says that we suffer loss by investing in stock market. The stock market are doing well. And if we are not investing, then why we are not investing if stock markets are doing well? Right? Because we don't know the skills. Now I'm coming back to my slides. Again, I'll come back to this. So now this is the basics of investing. That debt and equity are two things. Sensex and Nifty are the two stock market indexes. What is GDP and how GDP and stock markets are interrelated with each other. When was Sensex started? When was Nifty started? So this was the basics of investing, or we can say ABC of investing. Now let us understand the risk and return management. Why we people do not invest in the stock market? Because we don't want to take any sort of risk. We don't have risk appetite. We need to increase, we don't need to increase our risk appetite to invest in the stock market. We just need to understand what is risk and what is return. So stock market, one thing is for sure, we get 6% or 5% or 7% return on FD in the banks. We get assured return of 6%, right? In stock market, returns are not sure, right? And there is one thing which we need to understand. Then risk and return goes hand in hand. If your risk increases, only then you can, yeah, somebody is saying something. So risk and return go hand in hand. So they are parallel to each other. If you want to have more return, you need to take more risk, right? You cannot get good return without taking risk. But I am going to tell you, by taking negligible risk, you can have more return. You need to take a minimum risk if you want to invest in the stock market, the way I am trying to explain you. So stock markets are profitable only because they are uncertain, and banks are not profitable because they are certain. So because of risk and return relationship. So now let's understand the rule of 72. What is the rule of 72? In how many years we double our money? So this rule basically helps us to understand in how many years we double our money if we invest in a bank. So I show the slide again, the Excel sheet. So here I have written the rule of 72. So rule of 72 is 72 divided by rate of interest. So now just to make the things simple, I have taken 6 as a rate of interest. So 72 divided by 6. So in how many years we can make our money double? Can someone tell me? 12 years. If we follow this rule of 72, if it rates come down to 5, so we may take more than 12 years. And if rate increases from 6 to 7, so it may be 11 years or 10 years. So this is the rule which we follow to understand in how many years we double our money by investing in banks. So I'm coming back. Yeah. So now I have given one very simple formula, which is future value is equal to present value into 1 plus r raised to the power n. So what is FV? FV is future value. What we want to, FV is a dependent variable. Future value, what we want to have in the future. Present value tells us how much funds we are ready to invest at present. So this is the present value of our investment. One is one. This is simple formula. Mathematics people can explain it in a better way. So R is nothing but rate of interest, right? The rate of interest which we get by investing our money anywhere, whether it is bank or in the stock market. N here is number of years. So what people do and why people suffer loss in the stock market, I tell you, because they don't understand this formula. Why they don't understand? This is very simple. It seems to be a simple formula, but people make mistake while applying this formula in their actual lives. I tell you why. We always focus on R. We always focus on R. We want to have more and more and more of return. We want to invest where we get more and more of return. But the secret lies in N as well as PV. And if you invest for a long time, and if your N is large, if you're investing for 10 years, 20 years, 30 years, then what will happen? Your future value will increase. Future value increases not because of R. Abhi, I have just explained one thing, that there is a relationship between risk and return. If you want to take more risk, if you want to have more return, you need to take more risk. And Warren Buffett says one thing. Warren Buffett always says one thing, that my guru, Benjamin Graham, taught me 2 rules of investing. Benjamin Graham, his guru, taught him 2 rules of investing. Rule number 1, always protect your capital. Always protect your capital. And rule number 2, always follow rule number 1. Right? So what we do, why we suffer loss? To have more return, we invest in, we take some wrong decision to have more return. Because to have more return, we need to take more risk. We take more risk to have more return, and we suffer loss because of that. We don't need to worry about return. I'll show so many few more things so you would understand it in a better way. So we need to focus on N. Right? Warren Buffett says one thing: marry the stock. Marry the stock. When we marry with someone, what we do? We'll live with that person for rest of our lives, right? So Warren Buffett says that marry the stock, right? So once you invest, so then stay invested in that fund. So I'll explain that thing. So focus on N, people focus on R. And the second thing is present value. So how much you are ready to invest at this point of time, your future value depends on that. If you invest 1 lakh, so you would get return accordingly. If you invest 10 lakh, so you would get more return. If you invest 1 crore, so you would get, so your return, your future value depends on your present value as well as, and for how many years you are going to invest. And invest in the stock market. I repeat, I want to make this point clear. Invest in the stock market only for wealth maximization, not for your short-term goals. Okay. So now this is the theory. This is about the risk and return. Now I have written the 2 more points. What sort of risk we experience in the stock market? There are 2 sorts of, there are 2 types of risk which we experience. First is the risk of loss of capital. We always feel if we invest in the stock market, we may suffer, we may lose our capital. So Warren Buffett says always protect your capital. And here what I'm going to tell you, that you should I'm not I'm some of you may be thinking that after this webinar or during this webinar I'm going to tell you the names of the stock or name of the companies or name of the sectors in which you people should invest, and you can have lots and lots of wealth. No, I'm not going to do that. I'm not going to tell you any sector. I'm not going to tell you any stock in which you have to stay. You have to invest. I'm going to tell you one simple thing, that you should invest in the top 50 companies of the country. You should invest in Sensex top 30 companies. You should invest in top 50 companies. Whatever happens in the future, these top companies will always prevail, because these are that is why they are at the top. So I am telling you, and I have in the previous slide, I have also explained you one thing, that Sensex, Nifty, and GDP, they moves together. They are positively correlated, and the correlation between GDP, Sensex, and Nifty is 1. So I am telling you to bet on the Indian economy. I'm not telling you to bet on any individual company. I'm not telling you to bet on any individual sector. Bet on the Indian economy. Invest in top 30 companies. Invest in top 50 company, and then see the wonders. So you're not going to lose your capital if you bet on Indian economy. No risk of volatility. People say this thing. Commerce people always say this thing, that there is a lot of volatility in the stock market, and that is why we commerce people also don't invest in the stock market because of volatility. Volatility means there is a high variability in return. Volatility means high variability. Sometimes return increases, one day return increases, another day it falls, third day again it increases, then it falls. I'll show you the chart of Nifty. If you are investing for a long term, then there is no risk of volatility. I show the slide. 1 second. Yes. So is it visible now? So you can see the chart. You can see the chart of Nifty. Investing.com, all of you can go to investing.com and see the chart. This chart is available on web, right? I have not taken a copy of, from anywhere. It is available live. So you can see this chart. So this chart here, you can see, 1 minute. So here you can see the years, 1988, 2002, 2006, 2000. This is the chart of Nifty. This is the chart of top 50 companies, 2014, 2018, and 2022. Here you can see, here is the value. If I go here, 1996, here you can see, on the right hand side, the value is 1034. So the value of stock is, the value of Nifty is 1034. You can see it is, sometime it is going up, sometime it is going down, going up, going down, going up, going down, going up, down, down, down. So downfall, right? Then up, down, down. So this is a volatility. The stock market one day increases, another day fall, right? But if we see, if somebody invested in 2002, let us see the value of Nifty in 2002. It was 1034, approximately 1000. If somebody invested the fund in 2000, it is 2002. 1 minute. Yeah, it is 2001 now. Yeah, it is 1st April 2002. Is it visible to all of you? Yes.
Yes, sir. It's visible.
So you can see, if you invested in 2002 for a long term, after so many ups and downs, you can see in 2002 it is approximately 16,500. So from 1,000 to 16,500, from 1,000 to 16,500. So how many times it has increased? It has increased 16.5 times. I show you the Excel sheet now. So here you can see, I have not written about the Nifty. Let me write. Nifty, we have taken the data that in 2002 it was 1,000. Oh, I don't know why it has taken the percentage. It was 1,000, and now in 2022, I think it is automatically applying the formula. 1 minute. I open another slide. Sheet number 2. Let's see here. So 2002, the value was 1000. And in 2022, the value of Nifty is 16,500. So how many times it has increased? 16,500 divided by 1000. So it is 16.5. So Nifty has increased 16.5 times during the last 20 years, from 2002 to 2022. Let us understand one thing now. So the rate of return of the Nifty in the long run is 16.5. And people say that stock market is a risky thing and we lose money in the stock market. But the person who invested in 2002, in his investment would have increased by how many times? 16.5 times, my dear participants. So this is a myth that we lose money in the stock market. We can make lot of money if we invest for a long term. Now, so the question is loss of capital. Our economy is not going to get, no, it is not, it is going up year by year, right? So reversal is not possible, and no risk of volatility if we are investing investing for a long time. And wealth creation is possible only if we invest in the equity. Now, the third part of my presentation is, and one more part after this. So the magic of long-term investing. So what is the magic of long-term investing? So compounding is the eighth wonder of this world. Those who understand it earn through it. So compounding is the eighth wonder of this world. And how compounding works, we are going to see it. 1 second. So here I have taken a figure. Let us take a case of Dr. Anupam. If Dr. Anupam invests 1 lakh rupees in the stock market, okay, as per my advice, and leave it and forget it for the next 10 years. And here I have taken, we have in the chart, we have noticed that market has increased by 16.5%. But to be on a safer side, or to be a conservative investor, I have taken 15% only. So if the market increased by 15%, so if we invest in the stock market and it increases by 15%, so you can see the effect of compounding. If we invest 1 lakh, so after 10 years, it would be 3.5 lakh. And if we invest 10 lakh, so what would be the figure, Mr. Anupam? You would be surprised to know 3.5 crore. If you invest 10 lakh in the stock market in Nifty and Sensex and leave it for more than 10 years, I'm telling you, if you people invest in Nifty and stock, must invest it for more than 10 years and forget it. Marry the Nifty and forget it. And after 10 years, you would find a very big number, 3.5 crore. And what we call it passive way of earning. This is a passive. We are not doing anything. We have just invested and left it. This is the passive way, because we all are busy in our day-to-day life. It is not possible for us to go through the newspaper and to go through the stocks to understand in which stock we should invest, which stock to buy and which stock to sell. There are a number of studies which are there to understand the functioning of the individual stock. We do fundamental analysis to understand how the individual stocks are going to behave in the future. We do technical analysis to know people, and people have taken this as a profession also. They buy today and they sell it tomorrow, right? So but we call it speculation. When you buy for a short term and to have more profit, this is called speculation. There is one term, intraday trading. Those who buy on a regular basis, buy and sell on a regular basis, we call it speculation. They are doing speculation. And speculation, there is always a risk of loss in case of speculation. But investing is always for a long-term period, and there is no risk of loss if you invest for a long period. Then the power of compounding works by growing your wealth exponentially. So what you need to do, the first question which usually people ask from me, sir, where to invest? So I simply say, my dear friend, invest in Nifty, right? So the first, I think I have given the question of the first question, sir, what to buy? Sir, which company stock I should buy? which sector I should buy. So I'm simply giving you the answer, my dear participant. No need to buy any individual stock. Buy the Nifty and forget it. Right. So, and through compounding, you can you can grow your wealth exponentially. Right. It not only adds the principal, but it adds the profit earned back to the principal and then reinvest the entire sum to accelerate the profit. So what to buy? The first question is buy Nifty or Sensex, the top 30 companies or the top 50 companies. Now the second question which generally people ask from me, sir, when to buy? Sir, when to sell? Right. So you have given us the clue that Nifty, sir, should I buy today? Should I buy tomorrow? Should I buy after 6 months or after 1 year? Right? Am I too late to buy the Nifty or the Sensex? Then I say there are two simple rules of buying and selling in the stock market, which you all, I'm telling you the secret of investing in this slide, right? And Warren Buffett says one thing: be greedy. Note down, students, those who are attending the webinar, please note down. Be greedy when others are fearful, and be fearful when others are greedy. I repeat, be greedy when others are fearful, and be fearful when others are greedy. So my two simple rules of investing are based on this thing only: buy when everybody is selling and sell when everybody is buying. Now people ask, sir, how do we know that people are buying, or how do we know that people are selling? Then I simply say, you just read the newspaper. By whatever source you get an information that there is a blood on the Dalal Street. When you hear this news, there is a blood on the Dalal Street, it means that people are selling their investments, right? And if you someday, if you earn that there is a market euphoria, the market euphoria has been created, it means that people are buying. Market euphoria gets created only when lot and lot of people invest in the market, right? And the blood on the street occurs only when people sell. Sometimes you, I mean, you all must be aware of these two terms, and you must have heard these terms in your life: bull and bear. Bull bull is optimistic market outlook. Bull is when you are having an optimistic outlook, and the second is bear. Bear is when you are having a pessimistic market outlook. So always buy when people are pessimistic and always sell when people are optimistic. And this is the secret of investing. This is the secret through which you can make lots and lots of wealth, and you can fulfill all your dreams. Now, investment strategy. Now the next thing is what investment strategy we should follow. So we should there are two investment strategy I simply recommend. That the first strategy is you buy and hold. Right, you buy and hold. I'll prove this. Achha, one more thing I want to share with all of you. I want to share the Warren Buffett's wealth. 1 minute. Yeah. So this is Berkshire Hathaway. This is the company of Warren Buffett. You can see here it is written. So here, go to shareholders letter. Right. Every year he writes a letter to his shareholder. So you go there. You can see here the letters from 1977 to 2021. So let us open the latest letter written by the god of the investing, the person who created net worth of 11,000 crore US dollar. So let us read his letter. What is being included in this? Just look at this. So what he has done in this letter, he has compared two figures. You can see here year 1965, 66, 70, and 2021. And here, this is the market value of Berkshire, and this is the market value of S&P 500. S&P 500 is the topmost index of US. So what he has done, he has compared his profits with the profits of the US stock market. So it is very interesting to see here that in 1965, Warren Buffett, why I'm showing this to you, I'll tell you the reason. So in 1964, his profit was 49.5%, but the profit of the US market was only 10%. And in 1966, the figures which are given in bracket, these are the negative figures. So in 1966, he suffered a loss of 3.4. Then sometimes profit, sometimes loss, you can see. So profit, loss, profit, loss, profit, loss. Why? Because in the short run, we may suffer loss in the stock market. That is why I mentioned in the beginning that if you have a short-term goal, never invest in the stock market, because in the in the short run you may suffer. Warren Buffett also suffers loss in the stock market by investing for a shorter period of time. So you can see here, if I go down, so here he has mentioned compounded annual gain from 1965 to 21, approximately, math people are there, approximately 55 years, right? So in the last 55 years, his compounded annual gain is 20.1, and the compounded annual gain of the US stock market is 10.5, right? And now you can see the magic, the number, why he's so great. And my today's webinar is a tribute to Warren Buffett. After seeing this, I would say this webinar is a tribute to Warren Buffett, the great investor of the world. Overall gain from 1964 to 2021 is 3641613%. Oh my God. So annual gain is 20.1%, but when he invested for 55 years, his gain is 3641613%. My God. Right. So why I have shown this thing to you all, the reason being, if you follow me, okay, if you buy Nifty, if you buy Sensex as per my recommendation, you may suffer loss. You may buy today, and next year you may suffer loss, but in the long run you are going to get benefit of it. You are going, your money is going to multiply many times in the long run, right? So I come back to this. So one thing is buy and hold, buy and hold, buy and hold for next 20 years, 30 years, right? If you do that, definitely there is no scope of losing your money, because you are investing in Indian economy, and Indian economy is growing day by day. We have a population of 135 crore, right? So our consumption is, you can understand the consumption of India, and GDP is the final value of goods and services consumed in the country, right? So consumption is going to increase, new things are going to add in our day-to-day lives, right? So you're not going to lose, right? So there is a negligible risk. I'm not going to give any guarantee of it, but I'm explaining you the concept. There is negligible risk, and that is why Warren Buffett always says that to make money in the stock market in the long run, you need zero skills, you need zero knowledge, and by doing this you can make money without having knowledge and without having skills. Now the second thing is, which is very important to understand for all of us, buy and sell. Some people say, sir, no, it is not interesting to buy and just keep it with us for 20 to 25 years. There is no fun in it. We want to have fun in our lives. Then I say, okay, I tell you how you can have fun by investing. So I have taken one example. Uh, so here you can see I have noted down few events, right? So there was a dot-com bubble. After my webinar, students can search it on web, that there was a dot-com bubble during 2000, right? And we recovered from dot-com bubble in the year 2003. Right. I'm just first telling you the events. Then I have mentioned the second event is Reliance IPO. I'll explain what is IPO. IPO stands for initial public offer. Right. So those who don't understand stock market, don't understand commerce, they should write it down. IPO stands for initial public offer. And what is initial public offer? Whenever any company, right, think of raising money from the market, what they do, they issue IPO. Let us take a case. I want to open a company. I want to open a university. Since I am a teacher, so I don't know anything other than teaching, so I can open a university. Right? This is the biggest thing I can do in my life. So if I think of opening a university, what I need huge amount of funds. Okay, I'll go to Anupam. I'll go to other colleagues. Please help me. So but I don't feel they would be able to give me that much amount so that I can open a university. So for that, what I need to do, I need to go to the general public, right? I'll go to the general public and I'll issue initial public offer, right? Initial public offer means I'll give the shares of my company to the general public. right? So that they should invest their money, and I can have lot and lot of funds to open up my university. So I'll go to the public. So a company can raise fund from the general public by issuing IPOs, initial public offer. Now what happened whenever there are two situations in case of IPO. Sometimes what happens, whenever any company issue IPO, they get a premium on it. When I say premium, what does it mean? For example, I issued 1 lakh shares in the market, right, to raise funds, right? And 1,20,000 people applied for it, or 1,50,000 people applied for it. It means that market euphoria is at its top. I am giving 1 lakh shares. I am ready to give 1 lakh shares, but 1,20,000 people have applied, have sent the application for the shares. They have applied for it by giving some minimum amount. So this is a situation where there is a market euphoria, right? And we need to understand when the market euphoria exists in the market, or when it prevails, or for how long it prevails. So we need to understand. I'll explain that thing also. So the second thing is Reliance Ipo, means this is the time during January 2008, Reliance issued their IPO. They have issued their shares to raise funds from the general public. The third event is subprime crisis. There was subprime crisis in America. Financial crisis was there in 2008 because of some property bubbles and all. Then the fourth event I have taken, Coal India IPO. So Coal India is a company. They issued the IPO in October 2010. And the major event which I have taken here is Corona pandemic in March 2020, when there was a complete lockdown. That was a time of Corona pandemic. That was a time when Corona basically hit our economy. And I have taken the last is current market, which is March 2022. Now let us see what happens during these events, right? So this is the historical thing. So in 2003, when Nifty was started with 1,000 only, right? So in the initial few years, there was a sometimes I mean there was up and down, up and down. But in 2003, it was 1,000. Acha, one more thing which I want to tell you, that only fools and liars can predict the market. No one can predict the market. Only fools and liars can predict the market. People say to me that, sir, I watch this particular BBC news or something like that, some business news, to take the tips of the stocks. But then I say, only fools and liars can predict the market. It means if let us assume कि उनको पता है कि stock market में what is going to happen next day, then why they are giving reporting on the TV? If they know the future, so why they are telling this to everyone, right? Why they are doing this? Because that is a source of their regular income. They are the reporters. They earn because of that. That is a source of it. So never rely on TV. Never rely on newspaper. Nobody knows what is going to happen in the stock market tomorrow. It is totally uncertain. Achha, Warren Buffett says one thing very important. He says that Mr. Market, please note down, Mr. Market is a rational man. Mr. Market is a rational man, but sometimes it behaves like a drunken man. Mr. Market is a rational man, but sometimes it behaves like a drunken man, and we have to take the advantage of that time. Right? When someone behaves like a drunken, so we have to take a advantage of it. So we need to understand when market is in a drunken position. So these are the events which helps us to identify the time where the market is in a drunken form. Right. So let us come back to this. So Reliance IPO was in January 2008, subprime crisis 2008, then Coal India IPO. I show you the news. So here, yeah. So here you can see the news. LIC plans India's biggest ever public issue. Here are the top 10 IPOs so far. Right? When I read this, so I really surprised. So LIC is planning to launch India's biggest ever public issue. It may come in future. So after this webinar, you would be able to understand what you have to do during that time. So here they have shown the list of top 10 IPOs. So here you can see the first one, life insurance. They are planning. They have issued their red herring. They have drafted a prospectus, but it has not yet been issued. One time Paytm. So you can see the Paytm. So what does it mean? It means that Paytm has issued the share to raise money from the market. And when they issued, what happened? The issue size was 18,300 crores. Right? In the financial world, we always talk in crores. Right? The stock market is listed with a discount of 9%. But that time when they issued, nobody was interested in buying them. That is why they have given the discount. Generally, companies or sellers give discount when people don't buy their product, right? So they gave discount in November 2021 because nobody was investing their funds. Now see the second, the Coal India, which I have taken in my list. The company listed on the stock exchange with an issue size of 15199 crore in November 2010, and the stock is listed with a premium of 17%. So here you can see it was issued at a premium of 17%, and they raised 15,000 crores in 2010. What does it mean? It means that the market euphoria was at its top during that time. That is why they issued less number of shares and people sent more application for buying it. Right. So this is the event which we have to understand. So this is the time. What we need to do? Be greedy when other are fearful, and be fearful when other are greedy. So here, yes, Dr. Anupam, people are fearful or they are greedy? Yes, anyone can answer this question. People are greedy or fearful here? The company
Okay.
has yeah.
Yes, sir.
Yeah, so people are greedy here or the fearful? Can someone answer, students, participants? Coal India issued their
Greedy, sir.
greedy. Yes. So what we need to do? We need to be fearful. We need to be fearful. So what we need to do? We need to buy or we need to sell?
Sell.
Sell. When everybody is buying, you should sell it. When everybody is selling, you should buy it.
Right.
So I'm telling you the buying and selling strategy. So Coal India during this time when they issued it at a premium, so this is the time to sell, right? As per the quote. So Reliance Power was issued 111,563 crores in February 2008, and it was issued at a premium of 22%. I tell you, जिन लोगों को Reliance, I know all of you are the students or the faculty members, but जिन लोगों ने Reliance Power में invest किया था उनके आंखों में आंसू आ रहे होंगे मेरी बात देखकर. ठीक है, तो क्या हुआ? There was again, this was the time when everybody was greedy. So we need to be fearful. So we need to sell our stocks. So now you can understand at what time we have to sell when everybody is greedy. So we can take IPO as one event. Whenever you read in a newspaper that this is the ever biggest IPO in the country, so that is the time you have to sell. Right? So this is for know nothing. This webinar is for know nothing investor. Know nothing investor. You simply read in the newspaper or you get to know that there is a biggest IPO ever come in the market. So that is the time you sell it. Then subprime crisis. So crisis, at the time of crisis, what happened? What people do? They don't buy it, right? People during crisis, people start selling their shares. So this is the time we have to buy them. So be fearful when everybody is greedy and be greedy when everybody is fearful. So during the subprime crisis, everybody was selling their shares because they were fearful, right? Now let us see a case of corona pandemic, right? During corona pandemic in March 2020, I remember the day. I was sitting in my living room and I opened the Nifty. Even I was shocked to see that because even I was suffering a huge amount of loss at that particular time. So the Nifty fell down to 7,500 points. It was 7,500. from 12,000. From 12,000, it fell down to 75. But now in 2022, in 2 years, it is almost double, more than double. If somebody would have invested 10 lakh rupees, as per this strategy, buy during the crisis, this is the first crisis, this is the second crisis, and pandemic was the third crisis. So buy during the crisis and sell when the IPOs were oversubscribed. Sell. So if somebody would have bought at this time 1,000 point, 10 lakh. Let us take a case. Somebody invested 10 lakh rupees in 2003, and in 2008, if we sell, so what happened? Here the market has increased from 1,000 to 6,000 point. So by selling it here, one can have a profit of 6 times, 1,000 to 6,000. Again, then it decreases from 6,000 to 2,500. So here the people, so here you sell, here you buy. Again crisis, again you buy. This is the time to buy. Here you buy, here you sell, and have a profit of 6 times. Here again you buy, here again you sell. Then there is a profit of approximately more than 2.5 or something like that. So again you will have a gain. And if again you buy here during corona pandemic, and whenever you want you can sell. And here if somebody would have invested 1 crore rupees on during March 2020, so what would be the figure today? 2 crores in 2 years by doing nothing. So this is the magic of investing. But we need to learn the skills. We need to understand this. We need, what people do, they do the analysis of the stocks on a regular. It is not at all required. You simply invest in Nifty. You simply note down the events, right? Keep a track on the events, not on the market, but on the events, right? And whenever something happened bad, so you at that time, that is the time to buy, right? At the time of crisis, you buy, and at the time of IPO and biggest ever IPO, so that is the time to sell. So if you want to buy, if you want to follow buy and sell strategy, I have an example for you. And if you want to follow buy and hold, so you simply buy and forget it, and you can have a lot and lot of wealth after 10 years, 15 years, 20 years. I think I have explained everything. Yeah, rule of 72, Sensex, Nifty, compounding. I think I have explained everything. Now, this is the time for question answers. I am ready to answer all your questions.
Okay. Thank you,
One.
doctor. Basically, so okay, we have few questions from
Yes.
the students.
Okay.
Okay. So the first question is from Agra. Okay. So anyway, the C basically is interested. What is the good time to enter the market? So whenever the market is in boom or whenever is the market in the low. So is there any?
Yeah, I tell you. So the question is when to enter the market. What is the best time to buy? When I say market, I totally focus on Nifty and Sensex. So what is the best time to buy Nifty and Sensex? See, if you are investing for 20 years, right, or 15 years, so this is the best time. Don't waste more time. You have already wasted a lot of time, right? If somebody invests at the age of 20, right, for the retirement, so he or she gets 40 years to multiply his money, right? And if you're 20 years old, then you are very lucky that you got a chance to understand this. And we understood this at a very later age. So whenever you understand this, you start investing. And particularly when you are investing for a long time, so there is no point of waiting for the boom or the recession, right? Because nobody knows from tomorrow onwards whether market would go up or would come down. Nobody can predict. Only fools and liars can predict the market. Nobody can predict it. So this is the best time to invest in the stock market. After my class tomorrow, start investing in Nifty. And one more thing which I want to add in this. There are two ways to invest. You can invest in lump sum amount, or you can also start your SIP. I always advise to start SIP, right? So you start investing 1,000 every month or five. You can start a SIP by 500 rupees, right? So you start your SIP with 500 or 1000 or whatever amount you want, and invest it on a monthly basis, or if you want 4 times in a week on a weekly basis. It's totally up to you. It totally depends on your fund, how much funds you have for investment. So whenever you want, you can start, go for SIP. My advice is to go for, why I am saying SIP, because what happens sometimes during a year, in 1 month the market goes up, in another month the market goes down. So when you do a SIP, when you invest on a monthly basis, so you get a chance to invest both at the time when the market is down and both at the time when the market is up, and over a long period of time. So things gets balanced. So I always advise to go for SIP, and this is the best time to start your investing.
Okay, doctor. The next question is from Vaibhav. Okay, so basically she wants to know about how we can take about inflation and taxes on our investment.
Hmm.
Is there anything that we can think about that?
Very good question. This is very good question. 1 second. Is my screen visible?
Yes,
So
we can see the question.
yeah, so I tell you one more thing on this. Before 2017, right, there was no long-term capital gain, right? So you invest, if you are investing for more than a year, you don't need to pay any tax. But here I'm talking about 10 year, 15 year, minimum 10 years, right? So till 2017, there was no long-term capital gain. Nowadays, there is a capital gain tax. The government has now charging a long-term capital gain at the rate of 10%, right? There is no tax if there is no tax on the initial 1 lakh, on the earning of initial 1 lakh, and on subsequent income you have to pay a tax of 10%. If you I compare it with the bank. If you invest in bank, then you get a return of 6% or 5% or 7%, right? And the rate of inflation in our country is approximately 5% or 6%, right? If you are getting a return of 7% and the rate of inflation is 5%, so you are your real return is only 2%, which is your nominal return minus the rate of inflation, and the leftover part is your real return, right? And in the stock market, I have taken this. 1 second. Is my screen visible now, Dr. Kundan?
Sir, yeah, your screen is visible.
Yeah, here you can see one thing, that 100 rupees in 1980, 55,000 in 2022, and now government is charging a tax of 10%. So here 55 minus 55,000 minus 5,500, so the net return is 49,500, right, after tax. This is before tax and this is after tax. And here I have calculated the return. Here you can see 55,000. I have taken 50,000, 55,000, and here I have taken the after tax value 49,500. So in case of tax also, your return is 15.9%, and this is after tax and this is before tax. But return of more than 50% after tax is in itself a big number. So don't need to worry about it. Okay.
Thank you. Thank
Okay,
you. Thank you, sir. Thank you, Ravinder, sir. I would now like to take this opportunity to extend the vote of thanks. At the outset, I would like to thank our patron, Principal Professor Nirmal Jindal ma'am, for her constant encouragement. I would like to thank our keynote speaker, Dr. Ashutosh Goswami, sir, for sparing his valuable time to provide insights pertaining to investment. I would also like to thank our website committee convener, Dr. Anupam Sani, sir, for spearheading and executing this inaugural lecture. Our website committee member successfully organized endeavor of success. Anupam, sir, if you'd like to make any closing remarks.
Thank you so much
Yeah.
to all of you for giving me this opportunity to interact with my college colleagues as well as my students, right? In college, so we hardly get time to talk on these issues. So thank you so much for giving me this platform. Thank you to all of you. To first of all, a big thank to our respected principal, Professor Nirmal Jindal. She always motivates and inspire each one of us to do better in our academics, and that is why because of her inspiration and motivation, I am here in front of you and giving you webinar. And thanks to Dr. Anupam and to all the co-conveners for organizing such a wonderful session. Thank you to all the participants for listening me so patiently. And I hope you are going to apply the skills which I have tried to inbuilt in you. And I wish you happy investing.
Thank you so much, Dr. Ashutosh. On behalf of webinar committee, I would also like to thank our team members, Dr. Lach, Dr. Kundan, Dr. Swasti, and Dr. Sweta, Dr. Saranya, Dr. Ravinder, everyone else. Without this team, this wouldn't have been possible. Thank you, everyone. I will also request you to please fill the feedback link. It is also a feedback attendance link. So please fill that. I'm also sharing the link right now in the chat box. And there are more exciting things coming up soon. So stay connected. We will be sharing the Zoom link. We'll be opening the registration for other events also. By saying this, I'm ending this webinar. Thank you so much.
Thank you.
Thank you, sir. Thank you.
Thank you all.